The Federal Reserve meets next Wednesday, and it's all but a certainty that they're going to raise interest rates another 0.25%. The bears believe this is the rate hike that will break the camel's back, and we'll finally start to see stocks sell off after the incredible rally they've had through the first half of the year and last week. However, with inflation coming in cooler than expected and the consumer sentiment being off the charts, bulls believe that we're still going to see more rally from here. In fact, Fundstrat's Tom Lee believes that we will see an additional 10 to 16% from the first half of the year to the last half of the year. In other words, that we've got significantly more upside and will make all new highs in the S&P 500. What I do in circumstances like this, when the market feels frothy and we've seen a significant rally, is take profits and limit my losers. In fact, anything that is underperforming kind of gets a cut, because if it's not performing well in these environments, it's probably not going to perform well from here. Bitcoin really rallied on the back of the news that Ripple was going to possibly win its case, or at the very least not be considered a security when it was selling to retail investors. And even though that meant Bitcoin reached a new high for the year at $31,837.71, it quickly sold off on Friday, dropping all the way down a low of 5.93%. This drop was a bit of a shock because there was no catalyst for it happening. However, the good news is it was a higher low. Bitcoin ended up finding support around $29,950 before stabilizing, but as you can see, it had a very weak bounce. So the possibility that Bitcoin could see lower lows is very real. I don't expect this new low to provide much support. I'm more looking at the low of $29,850. If it breaks there, we're looking at $29,432.70, and as you can see, there's a big air gap down there. The parallel channels that we've been using might provide support here at $28,970, followed by support down here around $27,200. After that, we are looking at the $26,344 amount here, followed by $25,858, and so on. The bears in the space still believe the macroeconomic concerns facing Bitcoin are going to cause it to sell off, whereas the bulls believe the upcoming ETFs that are going to be on the spot Bitcoin price and offer more individuals the opportunity to invest in Bitcoin is going to cause the price to skyrocket. Right now, we're in a consolidation pattern. We're not going to know which way Bitcoin's going to go until it breaks out from here, either on the back of a catalyst or on whales either buying or selling from here. Coinbase was the big winner this week, rallying 33.76%. This came on the back of Ripple fighting the SEC and actually winning a pretty significant case. The courts determined that when Ripple sold its altcoin XRP to retail investors, that it was not an investment. In other words, that they shouldn't have expected returns or profits from the company, that instead it was a commodity. The SEC has been trying to prove the opposite of this, and that made it so the entire cryptocurrency sector took off. Later in the week, Coinbase got its own win when the judge in its case against the SEC sided with Coinbase over and over again, suggesting that the SEC expected too much from Coinbase. Both the judge and Coinbase believed that the filings that the SEC approved indicated that the SEC had done the due diligence. This is just logical. I do believe that Coinbase is a pretty decent long-term investment, even though it is an exchange and there are other exchanges, which means that it's not really in a moat. It doesn't have proprietary knowledge or proprietary technology. It is just another crypto exchange. That being said, it is the biggest crypto exchange, and I believe that they'll be a decent investment going forward. This week's loser was once again Canopy Growth Corporation, and as I've said before, this company just can't get out of its own way. The initial sell-off happened when they renegotiated $333 million worth of debt with their banks. On the surface, it seems like good news, but unless you haven't been paying attention to the economic environment, the restructuring of this debt was not beneficial to Canopy. They just didn't have any choice. They had to. Then later in the week, even though we knew that there were financial irregularities already at Canopy Growth, news broke that they had lied to the SEC when they filed how much their CEO was getting compensated. The initial filing said that he would receive $4.5 million for the 2022-23 year, and instead he received $6.5 million. In the scheme of the problems facing this company, that's certainly a small one, but there is so much going against this company that it once again made an all-new low and nearly closed at its bottom on Friday. Canopy dropped 19.29% this week, and there's just no sign that they're going to be able to right the ship. However, I have to admit I did throw about a Starbucks visit worth back into the stock. I was just under a round number in terms of how much I had invested and how many shares I had, and I decided to just add that much money back in. I'm not adding significantly. I am absolutely done at this point because I hit the exact cap I was looking for. I've mentioned in previous videos, and at this point, I'm just holding on for the long term. It is likely that Canopy's going bankrupt, but whenever I've cut losses in the past, it's ended up being a problem for me. Whatever stock I cut losses on ends up going up huge after I've cut it. So my approach now is just to take the loss when it goes to zero. And this isn't a big deal. I'm already down 90%. At this point, Canopy growth is about 0.3% of the portfolio. That's not even a ding. That's barely an intraday move. DraftKings continues to demonstrate that it is an excellent long-term investment. This week, analysts came out and said that the future looks rosy for sports gambling. Additionally, DraftKings has got their spending under control, so the company is getting closer and closer to profitability, which just makes this one an excellent long-term play. As a result of the good news, DraftKings popped 14.63% this week and was the winner in the speculation in play portfolio. Despite having been the winner in previous weeks, Carnival Cruise Lines was this week's loser when it rolled over on the back of concerns over rising capital costs. All of the cruise lines operate with a significant amount of debt. However, Carnival Cruise Lines is one of the worst offenders, having the most debt, which means it is fully exposed to the higher interest rates that we're seeing across the economy. What this means is when Carnival refinances any of its rolling rate loans, it's going to have to do so at a higher rate. This will negatively impact their profits, of course, and as a result, Carnival started to roll over and dropped 9.51% in a week that was positive for most stocks, easily making it the biggest loser of the speculation in play portfolio. After JP Morgan reported really good earnings on Friday and saw a pop, it was time for me to take some profits. Previously, JP Morgan had been its own allocation in the investments in play portfolio, but last year I decided I wanted to have exposure to the entire finance sector without adding more risk, so I split that allocation up into 4 different positions. In addition to JP Morgan, I also opened a position in Morgan Stanley, Schwab, and Visa. Accordingly, JP Morgan, which has been an excellent performer for the portfolio, is much bigger in the basket than it should be. So when it rallied after earnings, I had to take profits to reduce its allocation size. My sale went through at $151.56 on Friday and only locked in 1/3% in gains on shares that I bought for $151.16 on January 18th of 2022. But like I said, this is to reduce the allocation size. The sale lowered my per share cost 10.57%. down from $65.92 to $58.95. From here, my next buy target is $102.12, slightly above JP Morgan's 2022 lows, and my next sell target is $161.51, under a point of resistance JP Morgan has seen in the past. The rally in residential real estate has been huge, with the home builders just rocketing higher this year, and it's also been bringing up Zillow, the real estate website. In fact, the rally has been so significant, more than a double from where Zillow was in its bottom just about 8 months ago, I decided it was time to take more profits in the position. I do like Zillow for the long term, now that it's gotten rid of its ill-fated real estate flipping model that it was doing through the pandemic and finally dumped in 2021. This is an asset-light model, and its website is still #1 with realtors. However, with the rally it's seen, it's time to take profits, and I did so at $52.35. This locked in 8.97% in gains on shares that I bought for $48.04 back on January 26th of 2022, and lowered my per share cost 2.72%. down to $48.30. From here, my next buy target is $31.20, a key level of support that Zillow has seen many times over the years. My next sell target isn't going to be until $96.60. If this rally keeps going higher and it explodes in a mania kind of way, I expect that we could see significant gains. So I'm in no hurry to reduce my position size anymore in Zillow. I like this one for the long term. To learn more about long-term investing and to follow along in all of the plays in all of my portfolios, check out my website, getirk.com, which is always 100% free. Please hit like and subscribe. It really does help the channel out, and I'll see you in the next video.